Have you ever wondered how companies like Disney, Google, or Facebook became the giants they are today? Why is it that some companies seem to own absolutely everything? The answer often lies in a strategic business practice known as mergers and acquisitions. M&As. Cool, fancy business word.
CFOs, investment bankers, corporate raiders, hedge funders.
Let's dive into the world of M&As, the mechanisms, the legal nuances, and the most successful examples of M&As. At its core, M&As refer to the consolidation of companies or assets. Though the term is often used interchangeably, they have distinct meanings. What is a merger? What is an acquisition?
I'm sure it hasn't taken you long to understand the implications of this sale.
Let's cover those in turn. A merger occurs when two companies, often of similar sizes, combine to form a new entity. Both companies cease to exist independently and create a unified new organization. The goal is typically to achieve synergies where the combined company's value and performance are greater than the sum of the separate entities. 1 plus 1 is supposed to equal 3. Think of it like a marriage between two companies, except most of them really are death do us part and not, a couple of years at best. An acquisition, the A in M&A, happens when one company, the acquirer, purchases another company, the target. The acquired company becomes a part of the acquiring company, which retains its name and identity.
These fucking bones to make my bread.
Acquisitions can be friendly or hostile depending on the target company's willingness to be bought. Understanding these types of mergers helps in grasping the strategic reasons behind them. What's called a horizontal merger involves companies operating in the same industry, often as direct competitors.
Kid, enjoy it while it lasts, because it never does.
For example, if two smartphone companies merge, they can increase market share and reduce competition. A vertical merger occurs between companies at different stages of production in the same industry. A car manufacturer acquiring a tire company is an example. It aims to streamline the supply chain. They can get the tires directly from themselves. A conglomerate merger involves companies in unrelated businesses, like electric car company and a social media company. There's still some rationale behind acquiring an unrelated business because it diversifies business interests and spreads risks. And I'm sure a genius like, say, Elon Musk foresaw such calculated risks.
They call us traders gamblers. The world economy is just one big casino.
Companies pursue M&As for various strategic reasons. Growth and expansion are primary motivators. Organic growth can be slow, and M&A allows companies to quickly acquire new markets, technologies, and products. Synergies and efficiencies are also a significant factor. Combining operations can lead to cost savings through economies of scale, reduced redundancies, and shared resources. Diversification also plays a role. Expanding into new industries can reduce dependence on a single market and, again, spreading risk. And eliminating competition by acquiring competitors can increase market power and pricing ability. Sometimes mergers can also lead to tax benefits, but mergers in general, they're heavily regulated.
Something classy, old school, La Pasada.
Okay, so we understand the basic process, and understanding this basic process is essential. So let's look at what the specific players do. Let's see what first investment bankers do all night with the company executives. The acquiring company begins with strategic development, identifying its goals and how an M&A aligns with its strategic objectives. Essentially just planning out, whether to do an M&A or not. Target identification involves finding potential companies based on criteria like market position, financial health, cultural fit, and valuation and analysis assesses the target's value using financial models, Excel sheets, considering assets, earnings, and growth prospects.
An initial public offering. It's the first time a stock is offered for sale to the general population.
Once they have a target and a price, they might negotiate deal terms, which includes the price, the structure, and the conditions of the deal. And then comes sort of the integration planning where they plan to combine operations and systems and cultures and see how that works out.
Pretty good.
Finally, closing and implementation involves signing final agreements and beginning the integration process. That's essentially what investment bankers do for these companies, because often companies don't know how to do this, and bankers have done this many times, so they kind of hold their hands through this process.
We are selling to willing buyers at the current fair market price.
Okay, let's look at the next big money-making player, the M&A lawyers.
The toughest, smartest corporate lawyers do M&A.
Before any deal, the acquiring company conducts a thorough investigation of the target's financials, contracts, IP or intellectual property, liabilities, and legal obligations. This process uncovers potential risks, whether it's legal or otherwise, and informs the acquisition price. Due diligence failures can expose the acquirer to unforeseen liabilities such as legal disputes, regulatory penalties, and environmental issues. Essentially, you don't want to be buying a lemon.
Does so much work, above and beyond really, but...
Regulatory approval is another crucial aspect. Governments scrutinize M&A deals to prevent monopolies and protect consumers. In the US, agencies like the Federal Trade Commission or the FTC or the Department of Justice, the DOJ, review large transactions under antitrust law. Antitrust law, they essentially enforce anti-competitive practices, requiring companies to navigate these complex regulations, and they get lawyers involved to move this process along. Now, failure to comply to these antitrust laws can result in blocked deals, fines, or divestitures, meaning you have to give up certain parts of your company.
Be smarter or cheat.
Now, apart from these regulatory procedures, there's more nitty-gritty business contractual stuff. Contractual agreements are detailed contracts that outline the terms of the deal, including the purchase price, the representations and warranties, the indemnities, the covenants, and the conditions precedent, or what needs to get done before closing the deal. Contractual disputes can arise during post-merger integrations over obligations, representations, and warranties. So if something goes wrong and you're not happy with the company afterwards, you can sort of look to this agreement as a kind of planning tool to see what happens, what recourses there are, and see if you get any money back or a refund.
He'll do just about anything to protect his interest.
Now, litigation can be expensive and time-consuming, and it diverts resources from core operations, so it's best to be avoided. Financing arrangements need to be carefully structured for the deal. Often, companies don't have that much cash lying around to buy another company, so acquisitions can be financed through a mix of cash, stock swaps, or a combination of different financial structures. And there's going to be related legal agreements that govern these. Employees and stakeholder rights are also protected by laws, and during an M&A, there's issues related to layoffs, benefits, and contracts. Often, if you're, laying off certain executive employees, they get a very healthy sort of sign-off or a retirement package, sometimes called a golden parachute.
Banks took the money the American people gave them and they used it to pay themselves huge bonuses.
And the M&A lawyers really shine. M&A lawyers, they call themselves the quarterbacks of the deals, which is the same as like professional gamers calling themselves cyber athletes. Nice try, nerds.
I will not measure progress in inches, Ingrid.
Now that you know the basics of an M&A, let's explore some landmark M&A deals that have reshaped the industry. Disney's acquisition of Marvel Entertainment for $4.2 billion in 2009 allowed Disney to tap into Marvel's rich library of characters. It's a strategic move that led to the creation of the MCU, the highest growing film franchise ever, generating over $27 billion in box office revenue. Now, when it comes to Disney and Marvel, they're probably the best in the game at stealing old stories and fables and repackaging them. Facebook's acquisition of Instagram for $1 billion in 2012 was initially met with a bit of skepticism since Instagram had zero revenue at the time, but it was a really good move in the end. They recognized its potential. Today, Instagram generates over 40% of Meta Platforms revenue. Meta is Facebook's company, and it contributes more than $47 billion. The platform's popularity among young users helped Facebook maintain its dominance in social media. It was a good move. Nobody really uses Facebook anymore other than those dads that take front-facing double chin photos. In 2006, Google's acquisition of YouTube for $1.65 billion was another transformative deal. Google saw the potential of video content and acquired YouTube. The platform now accounts for over 11% of Google's revenue and is valued at around $168 billion. YouTube's global reach and advertising revenue have solidified Google's position in the digital advertising market. God bless the mighty algorithm and its untold influence on the world, for good or bad. Amazon's acquisition of Whole Foods for $13.7 billion in 2017 marked a significant entry into the brick and mortar retail space for Amazon. It expanded Amazon's footprint in the grocery sector, and it enhanced its distribution network, integrating online and offline shopping experiences. But, if you're buying groceries from Amazon, you need to rethink your life. The merger of Exxon and Mobil in 1999, valued at $81 billion, it created ExxonMobil, one of the world's largest publicly traded oil and gas companies. The consolidation helped the company achieve economies of scale, reduce costs, and it strengthened its position in the global energy market. How is this not a monopoly? I don't know. Who knows?
They stole from everybody.
Monopolistic concerns arise when large M&A deals reduce competition, leading to monopolistic markets. This can result in higher prices for consumers, reduced innovation, and unfair market practices. Regulatory bodies may block or impose conditions on such deals to protect consumer interests. M&As are not always beneficial. There's several reasons why M&As can be detrimental. Culture clashes are significant issues. Merging companies can often have different corporate cultures. It can lower employee morale and decrease productivity. The merger of AOL and Time Warner in 2000, valued at $165 billion, is considered one of the worst histories due to the significant cultural mismatch and strategic misalignment.
Behind on your credit card bills? Good!
Companies may overestimate the synergies achieved through M&As. Integration costs, operational disruption, or any unforeseen disruptions can erode the expected benefits of M&A. Studies have shown that a significant percentage of mergers fail to deliver the promised value to shareholders.
Firms have such a big advantage in terms of technology and information and just sheer wealth.
Acquisitions are often financed through significant borrowing, leading to debt burdens. The increased debt can strain the acquiring company's finances, and it can limit its ability to invest in other areas.
I have nobody to spend it with, nobody to enjoy my life with anymore. It's horrible.
If the anticipated returns don't materialize, the company might face financial distress. The loss of focus is another risk. Diversifying through M&A can dilute a company's core competencies.
Meaning past affects the probability in the future.
There are certain economic theories that highlight additional pitfalls. The winner's curse suggests that in an auction scenario, the winner tends to overpay due to competition. Similarly, in M&A bidding wars, the acquirer may pay more than the intrinsic value of the target company, leading to poor returns on investment. Agency problems also occur when managers pursue M&As for personal gain, such as increasing the company's size to boost their own compensation or prestige.
The real question is this: was all this legal?
This misalignment can lead to suboptimal decisions. Market timing can also be problematic. Some acquisitions are driven by market conditions rather than strategic fit. In booming markets, companies can rush the acquisition process and fail to do sufficient diligence, and this can lead to a lot of issues. While there are strong proponents of M&As, some think that they're mostly unsuccessful. Aswath Demaradon, NYU Stern Professor of Finance, is generally skeptical about the value of M&As in increasing the valuations of companies, mostly having to do with very nebulous terms like goodwill or synergy. It's not clear what they add to the intrinsic valuation of a company. He argues that M&As are the worst ways to grow a company.
Me, all right? I'm not a fucking athlete. This is my fucking way.
If done correctly, can drive growth, innovation, and market dominance, but the path is fraught with challenges. There's legal hurdles, there's cultural clashes, overestimated synergies, and a lot of unexpected economic pitfalls. Companies have to weigh the potential risks against the potential reward, keeping in mind that the best growth strategy might ultimately be just organic growth over an acquisition.
Looking at you like you're some combination of Warren Buffett and God above.
But at the end of the day, the real winners of M&As are the bankers and lawyers.
Stop going for the easy buck and produce something with your life.
Getting so much fees, tens of millions, just editing pitch decks and writing black lines.
Create instead of living off the buying and selling of others.
Yup.